For most people, the hardest part about buying a home is saving up for the down payment. Stocks can help you achieve that goal with compound interest. So in this video, I'm going to explain when you should put money in stocks for a home and what types of stocks to buy for this purpose. The first thing you need to think about is your time frame. If you have a strict deadline of needing to move in 1 year or less, investing in the market is not for you. You should just use a high yield savings account instead, because the shorter amount of time that you have your money invested, the more likely you are to lose money. Here's a chart showing the chances of you losing money if you invested at any certain point between 1929 and 2019. If you have your money invested for at least 5 years, you have almost a 90% chance of making money. This is taking data all the way back from 1926, so this is including the Great Depression as well. So if you don't have a deadline at all, you just want to move whenever you have enough money saved up, you should definitely use the stock market, because it's still likely that you'll make money over any of these given periods. That's because over the past 100 years, the stock market has returned an average of 10% annually. For example, if you don't have anything saved up and you start putting $200 a month into the stock market, after 5 years, you would have put $12,000 into the market and gotten paid $3,000 in interest, giving you a little over $15,000 total. If you are putting $200 a month into a regular bank account that pays you 1% interest, even if you did that for an extra year, you still wouldn't have as much, even with saving that extra $2,400 in that year. But once you have saved up to your down payment goal, take your money out of the stock market and put it in a high yield savings account so it doesn't dip back below your goal while you're searching for a home. In a different case scenario, if you already have some money to go towards a down payment, but having a strict deadline of 5 years to buy, you could put whatever you have now in the market, and everything you save between now and 5 years can be put in a high yield savings account. Because every contribution you make closer to your deadline will have a smaller and smaller chance of making money, as well as a bigger chance of losing money. As far as what type of stocks to buy, I think index funds are the best way to invest in the market. Index funds are a type of mutual fund that track a specific index like the S&P 500 or Dow Jones. It is a group of stocks that are bundled together, and when you invest in the fund, your money is spread out between all the stocks inside. The easiest way to buy an index fund is by opening a brokerage account. You can open this type of account with companies like Vanguard, Fidelity, or Charles Schwab. There are 3 main reasons index funds are such great investments. First reason is because they are extremely passive and you don't have to do extensive research on any companies, like you would have to do with individual stocks. Once you have picked a couple index funds that you like, you can set up on your brokerage account to have a specific amount of money invested every month into those funds. Pretty much after you have set up your brokerage account and linked it to your bank account, you don't have to do any more work to invest in the fund. You are also able to automatically reinvest any dividends that are paid to you back into the fund. Overall, it's probably the simplest stock investment you can make. The second reason is diversification. If you spent $1,000 on Tesla stock, you would only own a single company from that one purchase. If you spent $1,000 on an index fund, you would own a small piece of hundreds of companies from that one purchase. This shelters you when the market turns down, because it's less likely every single one of those hundreds of stocks will experience a drastic downturn all at the same time. Also, most index funds are weighted, meaning when you put money in the fund, your money is invested more heavily in some certain stocks over others. I'll explain that further when I talk about a few of my favorite index funds that I invest in. The third reason is very low fees. So with mutual funds, there are actively managed funds and index funds. Actively managed funds handpick stocks with a goal of outperforming a benchmark index like the S&P 500. This usually costs a fee of about 0.5 to 1% of the money you have invested, which means every year you pay $50 to $100 for every $10,000 you have in the fund. This pays the professional money managers to do the research and pick the best stocks. The problem is 90% of all actively managed funds didn't perform better than their benchmark index over the long term. So it is recommended by many to just invest directly into the index for better returns and much lower fees. The reason index funds have lower fees is because they just track the index exactly. For example, if the S&P 500 benchmark index gets rid of certain funds, so does the index fund. It doesn't have to be actively managed by anyone, it just mirrors what the benchmark does. For that reason, most index funds have expense ratios of 0.01 to 0.05%. This means every year you only pay $1 to $5 for every $10,000 you have invested in the fund. So personally, I like to use Fidelity as a brokerage account. They have very low fees compared to other brokerages, and their website is very easy to use. So here are some of my favorite Fidelity index funds. Every brokerage will have these funds just in their own name. For example, Fidelity has FSKAX as their total market index fund, Vanguard has VTSAX, and Charles Schwab has SWTSX. They all have pretty much the same same holdings, just under different tickers and different expense ratios. My second favorite Fidelity index fund to invest in is the S&P 500 with a ticker of FXAIX. This index fund tracks the S&P 500 and is composed of the 500 largest companies in the US ranked by market value. So that pretty much means the 500 biggest companies in America. Here's the entire list of the current S&P 500 holdings from largest to smallest. I'll leave a link to this list in the description. So before, when I talked about how the fund is weighted, that means a higher percentage of the money that you put into the fund goes more heavily into the bigger companies than the smaller ones. As you can see, Microsoft is the biggest company and 7% of your money gets invested here. And as the companies get smaller, the percentage of the portfolio does as well. After the 15th company, everything else is less than 1% of the portfolio. All the way to 500, where only 0.01% of the portfolio is invested in News Corporation Class B. The index is rebalanced quarterly, meaning every quarter the index changes out stocks that are no longer big enough to be in the top 500. So if in quarter 3, Exxon is the 500th company with a market cap of $1 billion, and Walmart is the 501st company with a market cap of $99 million. And in the fourth quarter, Exxon's market cap went down to $999 million and Walmart's went up to $1 billion. Exxon would no longer be in the S&P 500. So Exxon would no longer be receiving any weight in the fund, and Walmart would take its place, receiving the new weight, which would have a small impact on your return, but that's just explaining how the index works. What does have a huge impact on your returns is what happens at the top of the index. If Microsoft shrunk and Visa grew, Visa could now be receiving 7% of the entire portfolio and Microsoft could only be receiving 1%. So you can see how this has a major impact on your returns because you are automatically investing more into companies that are growing and less or even not at all into companies that are shrinking. But it is important to understand just how weighted the fund is. Currently, FXAIX top 10 holdings make up 32% of the total assets. This gives you an idea of how much the top 10 companies affect the fund and how diversified it is. Here are all the different sectors that make up the S&P 500. 30% in technology, which makes sense when you see the top 10, Microsoft and Apple. 13% in financials, and 12% in healthcare. This index fund also pays a dividend yield, which is currently at 1.72%. Dividends are just a percentage of the company's profit that they pay to you for owning their stock. Since the S&P 500 holds so many stocks and all companies pay their dividends differently, you will be paid a small amount each month, but most companies inside the fund pay their dividends quarterly or annually. So you will see a big spike in your dividend payments at the end of each quarter, with the biggest being in December. If you are just starting out in your investment journey, there is no minimum to get started investing in this fund. Unlike many other brokerages that require you to invest $3,000 to start putting money into the fund. And the expense ratios for FXAIX are extremely cheap at only 0.015%. That's only $1.50 for every $10,000 you have invested. But even more important than the expenses are the returns. This fund has a lifetime return of 10% since 1988, and in the past 10 years has returned 12%, right on pace with the S&P. So if 10 years ago you invested $10,000 into this fund, it would now be worth a little over $32,000. But my favorite index fund has actually been outperforming the S&P 500 for the past 10 years and takes a little bit more of an aggressive approach. With the ticker of FSPGX, it's Fidelity's large cap growth index fund. FSPGX invests at least 80% of its assets in companies that are included in the Russell 1000 Growth Index, which is a market capitalization weighted index designed to measure the performance of the large cap growth segment of the US equity market. So the Russell 1000 Growth Index invests in the biggest companies in the US that they determine to have high growth potential. The fund has a strict criteria of what a company needs to be designated as a growth stock and rebalances the fund annually to ensure that all companies continue to meet the criteria or see if new companies should be included. This fund has a total of 445 holdings and is much more weighted than the S&P 500, with the top 10 companies making up 52% of the total portfolio. Here's the major sectors of the fund, with 43% in technology, 15% in consumer discretionaries, and 12% in communication services. This is a very low-cost index fund with an expense ratio of 0.035%. or $3.50 for every $10,000 invested. And since these are mostly growth stocks, companies tend to reinvest their profits more. So the dividend yield is smaller at 0.7% and distributes them biannually. There is also no minimum to start investing in this fund either. But the best part about this fund is the returns. As you can see, this fund has gotten the best returns out of all of Fidelity's index funds the past 5 years at 16%. The lifetime returns of this fund are 17% since its inception in 2016, which is the best out of all the funds Fidelity has, including actively managed ones with 1% expense ratios. Here it is compared to the S&P 500. I put Vanguard's version of SSPGX so you could see the 10-year comparison. If 10 years ago you invested $10,000 into the S&P 500, you would have right around $32,000. But with the growth fund, you would have $7,000 more, or almost $39,000. $39,000 is more than enough for a down payment on a house, but you would still need a lender to fund the rest. You can watch my video here on how to get a loan to buy real estate, or if your credit score isn't good enough to be approved for a loan, you can watch the secret to getting a perfect credit score video first.